Hey everybody, Boris. Welcome to the weekly technicals for December 12th to December 16, 2016 for the majors for Euro dollar, dollar yen, and pound dollar. Well, this is the week where everything comes to essentially what we call in America rubber hits the road. FOMC or bust is the title of this week's technical analysis because everything is going to be resting on what the FOMC meeting going to do on Wednesday. The conventional wisdom, of course, is that the Fed is obviously going to raise rates 25 basis points. I think that's pretty much a done deal. The much more interesting and the much more volatile component of trade this week is going to be whether the Fed essentially communicates the idea that they're going to normalize monetary policy. That is, they're going to be on a path of at least 2, perhaps even 3, as much as 4 hikes next year. The idea is that they're essentially going to return back to normalization and raise rates in concert with the growth of the economy. Or, and I think this, the second scenario, is one that probably could take the market by quite a lot of surprise. If they are much more reticent to proceed with any further rate hikes beyond the one that they've already done. There's a couple of reasons for why they may want to do that. First of all, rates have really gone up tremendously since the Trump election, way ahead of where I think the Fed wants them to be. And that's already had an impact both on financing and an impact on most likely profits in Q4 for all of the U.S. multinationals, because the strength of the dollar, which has gone up to 15, 16-year highs on a dollar index, is clearly going to have a negative impact on corporate profits. I think the Fed is very, very cautious, or sort of very cognizant of the idea of not trying to strangle the U.S. recovery. And for that reason, maybe far more cautious than the market thinks. Certainly a lot of the Fed officials, including Philly Governor Bullard, or St. Louis Governor Bullard, sorry, have been far more cautious in their forward guidance by saying that one hike is pretty much all we need in order to tighten up the policy at this point. And the fact that the rates themselves, the rate curve itself, has gone up so parabolically over the last 6 weeks or so, pretty much doing the Fed's job for it, not just for a month forward, but perhaps 6 to 7 months forward. So I think given Janet Yellen's general tendency to be more dovish than hawkish most of the time and give the economy the benefit of the doubt, there is very little inflationary pressure in the Fed at this point. Even with the rise in the oil prices, we're going to let the sirens go by in New York City for a second. My apologies. Even with the rise in the oil prices, the general price level in the U.S. economy still remains well below the 2% level, and therefore the Fed, I don't think is really as worried. And more importantly, and this is the critical thing, there hasn't been a massive uptake in wages. Average hourly wages have actually declined. So therefore, until what we call the wage push inflation, until wages in the U.S. begin to really start to accelerate to the upside and the labor market tightens to the point where they now have to raise wages, the Fed really has zero reason to want to tighten policy any further beyond the current rate. At this point, the market is very hopped up and certainly feels like it is going to go towards a more normalization policy. So a huge amount of Fed tightening has been priced in going forward. Any kind of a disappointment very likely to create a possible profit-taking rally in the dollar. Let's take a look at the levels here just to see how the market sets up ahead of the FOMC meeting on Wednesday. So we have the euro dollar now at very, very critical support, this 105 level. And the resistance now stays at around 108 after the fake out by Draghi that turned the euro from a buy to a sell instantaneously on Thursday. But at this point, we're essentially in this 105, 108 range. And we'll take a look at the charts in just 1 second to see exactly how it stands. As long as the 105 kind of holds, there's a potential here to trade right back up towards the 107, 108 if the Fed disappoints. Conversely, dollar yen now into that 115 level. Remember, dollar yen generally trades in this in the 5 penny levels or 5 yen levels. So we took out the 110, 115 zone, and now we're in the 115, 120 zone. The critical question here is this 116, 117. If we begin to teeter, it's very likely we could dip back into the 115 zone on any kind of a Fed disappointment. So I'd be watching those levels very carefully as the week develops, and then, of course, into the FOMC meeting. The pound has sort of been a story of its own. And of course, the Brexit battle continues in the courts. But in the meantime, cable has been showing sort of a long-term uptrend pattern. And as long as the 124 holds, that uptrend pattern pretty much remains in place, although it's a very, very choppy pattern, as we can see on the charts. Let's take a look at the charts, as a matter of fact, right now, and just see how everything develops. So here's the euro. The euro effectively, after the big move on Monday and the big reversal on Thursday, still remains a 105, 108 trade. And we are very, very close to these very key support levels. A break of the 105 certainly opens up a possible run all the way down to 103.50, especially, and this is the critical thing, if we break the 105s and the Fed comes in very, very hawkish into the FOMC. On the other hand, we could have a dip below 105 pre-Fed and then a complete reversal and perhaps even a move all the way out to 106, 107 or any kind of a disappointment. So I would be very cautious in trying to trade the break unless I had the confirmation fundamentally from the Fed that yes, indeed, they're going to go full force. At that point, the euro could then target parity, and that certainly could be a very, very big story going forward. Dollar yen, similar kind of a story, but from the opposite side, where we took out the 115s, but just barely. We're nudging into this 115, 120 zone. And again, a reversal here, a break really of the 113s to the downside would suggest a near-term top and consolidation and perhaps a move all the way down to 110s as profit taking begins to kick in. Remember, yen is a, what is it called? They call it a staircase up and an elevator down. If we get a shockingly surprising dovish commentary out of the Fed, it's not at all impossible to imagine the yen dropping 200-300 points in a day. So I'd be very, very cautious in warning you that if you get long this and it begins to reverse, I wouldn't want to try to catch it on the way down. And last but not least, here's the pound, and here's what I'm talking about as far as the overall long-term positive slant to the trend here. You have a series of higher lows, but a very choppy up and down move. And as long as the 24s hold, pound dollar still remains a relative uptrend. Of course, the key level here is going to be this 129, 130, the post flash crash highs. Those are the ones that the market is going to be looking at. And of course, the 129 is a very, very key psychological level. UK data has been very mixed. We have the BOE minutes, and we have the UK labor data coming up this week. So it'll be interesting to see if we're getting kind of a positive upshot from that. But generally, it's really going to be a story of what's going on in the backbenches in Parliament as far as Brexit goes and how well they can negotiate that for the time being. Cable still remains, of all of them, on a relative strength basis, a stronger trade. But we'll be watching that very carefully. If 24 goes to the downside, a lot of this upward slant will be completely erased. So really the big story this week is, of course, the 105 in the euro, the 115, 116 in the dollar yen, on a more mild side, the 124 in the pound, and all eyes on FOMC on Wednesday, as that's going to be the primary driver of trade and will determine probably direction for the next 2 weeks to come. Wish you guys the best luck, the best of trading. Boris, over and out.